Okay, Assalamualaikum. Let us start the class officially. Let us start the session with Al-Fatihah. Bismillahirrahmanirrahim. Alhamdulillah. Yeah. Okay, is my voice clear? Because I'm turning on the fan above my head, so can
Yeah.
you hear my voice clearly?
Yeah, it's clear.
Okay, Alhamdulillah. All right, Munira, how are you?
I'm sorry for being late. I thought it's 9:30.
Okay, no worry. I'm just about to start actually. Okay, so let me just explain to you about the assignment, yeah. So the assignment, I give you five question. 5 question, all the question give you 20% and then the total will be 100. So the first question is about accounting principles, yeah. So actually accounting principles is actually what is the the basis of which the accounting system is built, you know, the principles of where accounting system is built. So what does it mean here? Actually, it has more than 5 actually, but I just require you to explain 5. So you have to search it in any accounting book, yeah, any basic accounting book, or you just Google on internet, you can get, yeah. Especially you can go to accounting coach, for example, the website of accounting coach or anything to do with accounting website, you can find this all these principle, yeah. Among the website that you can search for this information is accounting coach, and then ACCA. So ACCA is a professional body for accounting, so they have also this material. Okay, so let me just explain to you the base what does it mean by accounting principle. So it is actually they are built on the foundation of few basic concepts, yeah. In order to understand accounting, you have to understand this underlying concept. So what does it mean by going concern concept? Yeah. So when we prepare accounting for companies, yeah, it is based on the understanding. It is based on the assumption that the business will be ongoing. The business will be ongoing. So we usually business, of course, some owner when they start a business, of course, sometimes they have strategy when they want to exit the business, but of course the business is the purpose of establishing its business is to enhance the wealth of the shareholders, and then usually it will be like they also aim to have it like forever for their own, you know, for their own needs of income, and then of course for the next generation. So when we prepare accounting, we actually assume that the business is ongoing as well. So that is actually what does it mean by going concern concept. So that's why when we prepare accounting, we always like looking forward to see what will happen this year and what will happen next year. So that's why when we record everything, all the accounting transaction, we are assuming that the business will be ongoing. Okay. All right, the next one is conservatism concept. So conservatism means when we estimate about return, when we estimate about income, when we estimate about, you know, when we estimate about income, when we estimate about return of investment, for example, we have to estimate that the income or the return would be lower. So it's like, you know, we shouldn't be too optimistic, because we don't want to be too optimistic, because of if we are too optimistic that and the you know, the anticipation or the estimation would not be correct. So better to be a bit moderate about anticipation of income or return from investment. Okay, so that's what it meant by conservatism. Okay, on the other side of the coin, if we are talking about cost or we are talking about expenditure, so those costs or this expenditure is good to be a bit of higher side. So for example, let's say we are estimating about the cost of human capital in a company. So it's good to estimate that the cost is at the high side, so that we can, the business can be prepared for the worst. So that is what it meant by conservatism. So just like relate to our staff, for example, when we are talking about our income in future, salary in the future, so what is our increment in the future, it's good to not to estimate too high so that it won't give us false hope. So it's good to have a lower expectation on income so that we don't like be so frustrated, something like that. Yeah. And then when we are talking about the impact of inflation on our income, for example, yes, so it's good to have a higher expectation on the inflation so that we can be prepared. For example, the official inflation is about 2% in Malaysia. So when we are estimating how much we want to prepare for our future expenditure, it's good to be at a higher rate of inflation. Like let's say we use at 3%, so that we can be more prepared in the future if we expect cost to be higher, right? So understand the concept of conservatism. Yeah, conservatism is like, a bit moderation. So so it is like in line with the principle of moderation in Islam. So when we estimate something that is good, don't estimate too much, don't estimate too high. But when we estimating something that is bad, better to think of the worst so that we can be more prepared for the future. Yeah, for example, we will be like, now COVID-19, so we have to be more conservative in spending. Don't spend too much because because of we don't know the future. And then when we want to expecting income, so we shouldn't be like expect too much because of the uncertainty is actually still there, and because of COVID-19. So that what it meant by conservatism, right? Okay, and then the next one is matching concept. Matching concept is in accounting, we have to match income with the expenditure. We have to match income with the expenditure. So which means that to generate the income, there must be the expenditure related to it. So we have to match the income with expenditure. Then only we can calculate the return or the profit from that particular expenditure. And then if we are talking about, when we are buying an asset, there must be the source of financing for us to purchase the asset. Yeah, so that is the matching principle. So we always match income with expenditure, and then asset with liability or equity. So that will explain, for example, in the case of we buy an asset, it will explain where the money come from to buy an asset. Yeah, and then in income. So how to generate income? Of course, there will be a cost to it. So that's what meant by matching concept in accounting, right? So because of this matching concept as well, we have this debit and credit in accounting. Because for example, when we want to record a purchase of asset, which is at the debit side, when we purchase asset, that will be at the debit side, which means there will be an increase in asset. So of course there will be, the source of financing where we used to buy the asset. So the source of financing should be recorded at the credit side. Yeah, so it is a matching concept, right? Okay, the next one is consistency concept. What does it mean here is in recording finance, in accounting, in recording a transaction, we have to use a consistent method. Yeah, for example, if we are in estimating the amount of inventory, yeah, there are a few methods. For example, we are using first in, first out. What does it mean by first in, first out? When we buy an inventory, let's say we buy stocks of good, yeah. Let's say the Tesco, they bought 100 packs of rice in January, yeah. And then in February they bought another 100 packs, and then but the price will be different. The price in January would be let's say 32 per packs, and then the price in February, let's say 34 per packs. And then so the price will be different from one day to another day, or one month to another month. Yeah, so the stocks would be at different price, right? So in order to estimate how much the value of the stocks at the end of the period, So sometimes the company will use first in, first out, which means they will say that, okay, the first one that we bought will be the first one that we will sell to the customer. So they will use the price of the stock which they buy in January, because they assume this is actually the stock that we bought, but we sell to the customer. So meaning that the one that is so that's how the so the one that is sold is actually the first one. That's why it is said that first in, first out, right? Okay, another concept is last in, first out. So it is known as FIFO or FIFO or LIFO. FIFO is first in, first out. LIFO is last in, first out. So that's one of the one of the methods in estimating the amount of inventory. So the last in, first out means that, okay, when they want to record the amount of inventory at the end of the year, they will assume that the one that they bought in December, yeah, will be the one to be sold first. So they will use the price in December to estimate the price of goods that they sold to the customer. So that's what it meant by last in, first out. So because of there are a few methods in, for example, in this particular inventory measurement. So that's why we have to be consistent. So meaning that if the company choose to use FIFO, the first in, first out, so they have to consistently using FIFO throughout the period of accounting. So this is to ensure that the user of accounting information can compare. You know, it is can be compared, or the information can be compared fairly. So meaning that it will give the same value, not the same value. What I mean is the basic of how the inventory is measured is the same. They are using FIFO. So so a company cannot use like this year they use FIFO, next year they use LIFO, because it will give different value. So the user of their financial information will have a wrong information, will have an inaccurate information about the situation of the company. So that's why it is a requirement by the standard body of accounting that is requiring that the requirement by standard accounting bodies to ensure that the companies that preparing the financial statement should use a consistent concept. Yeah, if they use FIFO, they have to use FIFO throughout the period. So if they want to change, they have to announce. They have to announce in the annual report. They have to announce that, okay, this year we are using LIFO, something like that. So they have to explain so that the user will understand why the difference in the amount of inventory, for example. Okay, any question on this? Okay, so that's the consistency concept, right? So in preparing financial statement, the company have to use a consistent rule, consistent policy, consistent method. All those have to be consistent. If there is changes, they have to explain in the annual report so that the user know that there is a change in the concept, or there is a change in method that they use in calculating some item in the company, right? Inventory is just one of the things that have a few methods in measurement. Another thing is inventory. Another thing is depreciation. And depreciation, if you still remember what I explained about depreciation. Okay, depreciation is, for example, when we buy, when the company buy a building, the building definitely will depreciate by time. Depreciate means, by wear and tear. Of course, when the building is used, it will be depreciate in value. For example, if they bought the building for the price of 1 million, and then they estimate that the building can be used for 20 years. So the 1 million divided by 20 years, so they will depreciate the value by the number of years. Yes, so that will give the depreciation amount to the asset. Yes, so okay, let me calculate. For 1 million divide by 20 years. So what will be the depreciation? 1 million divided by 20 years. So it will be about 50,000. Yeah, so 50,000 a year will be depreciated. So it is like assuming that the asset would be we depreciate in value to the amount of depreciation would be 50,000 a year. So they have to that method is known as straight line method. Straight line method means that the value of the asset is assumed to be depreciated on a straight line basis, on the fixed rate basis. Yeah, but another way of measuring the depreciation is known as reducing balance method. Yeah, where the percentage will be calculated based on the balance of value of that particular asset. All right. So those so if the company choose straight line method, they have to consistently using straight line method. So again, if they want to change the method in calculating depreciation, they have to inform in the annual report. So that's what it meant by consistency concept, right? Okay, the last one, materiality concept. So what does it mean by this concept is when we prepare an accounting record, when we prepare accounting statement, yeah, so we have to only take into consideration the transaction that is material to the company. So material means that it has the financial value to the company. So that is what when, if you remember, I mentioned about the the weaknesses of accounting. Yeah, one of the weaknesses of accounting is it doesn't take into account other than financial information. It is only recording the financial information because of this concept, materiality concept, meaning that in accounting we only record things that have financial value, which financially material to the company. All right, so these are what it meant by principles. So you can read further, and then I expect you to have an answer of, maybe you just imagine if 20, meaning that one would be 4 marks. So I expect you to have at least 5 lines of answer, 5 lines. Yeah. So I want you to type properly in a word form, at least 5 line of explanation of every concept, right? Okay, second question would be about defining all this particular item. Yes.
Every like A, B, like A has to have 5 lines.
5 line, yes. At least every question you have to answer 5 lines. So every one of this 5 lines, 5 lines.
We will give examples.
Say again.
We will give examples, right?
Yes, it's good to give an example. Yes, so that you understand as well. When you have an example, you can understand as well. At least in Wikipedia also they have. Yeah, usually I myself also always refer to Wikipedia. You know, all the Google actually. I always search the information in Google actually.
Do we have to make this citation or references?
No need. Yeah, no need. I don't like citation actually. I don't like citation. You don't have to use citation. You don't have to do reference. But I expect you to use your own words lah when you refer to internet, for example, or you refer to book, for example. I expect you to reword what you read and then put in your own words. Yeah. As long as when I read, I understand. Yeah, so that's important. That means if I read, I can understand, in that you also, I hope you also understand lah. Yeah, so don't just copy without understanding. And because of this is actually part of learning process, right? So I don't want any citation, I don't want any reference to be made. No worry, you don't have to do that. Yeah. Okay, but if you want to put, then it's fine. But I don't require that. Yeah, I don't require that. But if you want to put, fine. Yeah, but it's not requirement in this particular assignment. Okay, and then question number 2, define the following terms. Asset, what is asset? What is liability? What is equity? What is income? What is expenses? So we will cover this in this particular topic today. Yeah. And then question 3. One way of reviewing accounting is a form of service. The value of the services to the various user can be judged according to whether the accounting information meets their needs. To be useful to users, the information provided must possess certain qualities. So this is the qualities of accounting report. So so there are at least more than 5 actually. So I just require you to come up with 5. So relevance. What does it mean by relevance? So accounting information have to be relevant. Yeah, accounting information have to be relevant. So meaning that all the information being revealed in the accounting in a report or financial statement have to have relevance to the user, meaning that it's important, it has value, it has meaning to the information. For example, when the company buy goods to be sold, by inventory, or when the company buy a building, the information is relevant. The information is important for the user to know why the company is buying the building. So that's why it has to be reported, because of course, one of the reasons, because of it is material, it has financial value. So that's why it has to be recorded. So relevance means the information is important, have relevant to the user. User need to know where the money of the money owned by the company is spent. Yes, so that is what it meant by relevance. Faithful representation means the information have to be truthful, have to be true, and giving a fair view of what happened in the company. Okay, so it has to be true information. Okay, so that's why if you remember, I show you the annual report of Nestle. I show you the audit report, right? The auditor's report where they attach in the annual report. They attach the auditor's report where auditors endorse the annual report. All the information revealed in the annual report is endorsed by auditors, saying that it is giving a true and fair view. So meaning that the information is true. The information is not information that they create. Yeah, so that have to be one of the quality that accounting report have to have, right? The next one is comparability. Yeah, so what does it mean by comparability? So all the information have to be comparable. For example, the information this year have to be comparable to the information last year. So that is actually related to the principle of consistency just now. Under principle of consistency, company have to use a consistent method. For example, if they are recording the inventory, it has to be on first in, first out basis. So they have to use the concept throughout throughout their life of preparing. So why the consistency is important? Because to make sure that the annual report or financial statement prepared is comparable, can be compared from one year to another year. Yeah, and then further, why the information that why if they change the method that they use, they have to reveal in the annual report that they change the method. So because of this is to make sure that it is so the user can understand. Yeah, so comparability is not only among the years, meaning that not only between one year to another year, but it is also between companies to another companies. For example, Nestle, when they prepare the annual report, they are using, let's say, FIFO to measure their inventory, and then they are using straight line method to record their depreciation. So everything that they use will be explained in the annual report as well. Yeah, there will be one portion where before the start of the financial reporting, there will be a list of accounting policy. So in that particular list, you will see what are the policy that they use, what are the method that they use. So the reason why it is required because of this is to make sure that the information of Nestle is comparable to another company. So let's say an investor, they want to understand food industry. So they take a few annual report. In a report of Nestle, and a report of Dash Lady, and a report of FNN. So when they look at the annual report, they can understand what does whether this company is good or whether that company is good or better. So they so that comparability will allow the user, or in this case the investor, to really understand the performance of company, and then they can make their decision which company they want to invest, which company is good one, because the information is comparable. Okay. Verifiability. So here what does it mean is all accounting information is able to be verified. So when they record, let's say they record a sale transaction, there must be a document to support the sale record. For example, when they make a sale, there must be an invoice that they send to their customer to record their the sale amount. So there will be an invoice, and then so the invoice will be one of the document that prove that there is a sale made by the company. And then when the customer pay, of course the company will issue receipt, right? So the receipt is the document that will support that the fact that there is money already being paid by customer. So that is what it meant by verifiability. So this is actually will facilitate the process of auditing as well. So I did mention to you auditor, the auditor, third party auditor, when they want to audit the company, sometimes they will come to the company and then they will stay in the company for 3 weeks, for 1 month. What they do is they will request all the supporting documents. They will request all the the invoice. They will request all the receipt, the compilation of receipt. So what they do, they will make sure that the total being reported here is true, is actually coming from that particular sources of information, coming from that invoice, coming from that receipts. So they have to check one by one the total. And then sometimes if the document is too large, too many, the amount is so many, so they have to use sampling as well. For example, out of the, let's say the company have 1 million pieces of invoice, because let's say company like Tesco, the big hypermarket, definitely the receipt is like millions for a month, because they issue receipts like almost in a day, I would say a few thousand to their customer. So definitely in a month, more than 1 million of receipt being issued. So in that particular case, usually auditor will use sampling. They will use like 30% of the sample, then they will check to make sure that the record is true, So if the 30% that they check is 100% correct, then it is like they can assume that the rest of the document, the rest of information are correct as well. And so those are verifiability. So all the information have to be able to be verified. There will be supporting document to all that information. And then last one is timeliness. Timeliness is in accounting, when we prepare the accounting, it has to be timely. For example, if the financial year end of the company is 31st December, so the annual report have to be published at least 3 months from the year end period. So if the financial year end is 31st December, at least 31st March, the financial report have to be out, have to be published already. If not, it is not really like timely. It will be like outdated. So that's why it is information to be very timely. All right. However, there are companies who delay in their financial reporting, then of course it indicates something wrong. It indicates something wrong. If the company takes so long to publish the accounting, it must be something wrong with them. Or if they do not get the auditors to audit their financial statement, there must be something wrong with them. Like recently, there are news that a few NGOs who were collecting monies from public, from the people, they are not submitting their financial statement to auditors for quite some time, for 5 years. So it means something is wrong with their management. It is something is wrong with the management of people's money. So that's why we have to be careful. If you want to even donate our money, make sure that the one handling the money is a truthful one. So their accounts have to be audited. Their accounts have to be prepared, have to be shown to the public, and then have to be audited. Right? Then only we can be comfortable that our money is used for the right purpose. If not, it's like going into their pocket. Yeah, there's a lot of things like that nowadays. Okay, so those are the qualities of accounting information. So I hope I already explained to you. I hope you can answer, but it's good for you to refer more on various books. You can also refer to internet, right? Okay, the next one is about accounting information. So where you are given a few information or few data, and then you are expected to prepare the statement of comprehensive income, right? And then this one, the same goes to this one. This is about Fatonah Berhad, the information about Fatonah Berhad. This one is about income and expenditure. So you have to prepare statement of comprehensive income, okay, or profit and loss statement, something like that. Okay, the last one is the information about the asset, liability, and equity. So then from this statement, you are expected to prepare statement of financial position. Okay, so it's like balance sheet of the company. You have to be balanced asset with liability plus equity. Okay, so those are all the questions. So please submit this assignment 2 weeks from now. Yeah. It's the deadline is 22nd April, 12 p.m. Okay, so please submit on via Classroom. Any question? Okay, if not, I stop sharing and then let me share the slides for today. Okay, today we will learn about transaction analysis and accounting record. So it's something to do with accounting equation as well. All right, so at the end of the session, you are expected to be able to understand the fundamental of concept of accounting equation in record keeping, and then identify the types of accounting entries. Okay, I already covered some of this, yeah, and then I will make sure that we go to the place where we stop. All right. And then explain the rationale of double entry system and prepare basic financial statement. Okay, so all right, accrual base. Okay, we actually covered some of the related contents in previous slides. Yeah. So in accounting, what you have to know, if there is a two concept in recording the accounting, which is known as accrual versus cash basis of accounting. What does it mean by accrual and what does it mean by cash basis? Let me explain by cash basis first. Yeah. So cash basis accounting is actually an accounting treatment whereby accounting record, the transaction will be only recorded when it involves cash. Yeah. So what does it mean here? So let's say the company make a sale of 20,000 this year and this today, but out of 20,000, 10,000 is cash, another 10,000 is on credit, meaning that the customer don't pay yet. So in that particular situation, the company will record that the sale today is only 10,000. Yeah, because another 10,000 don't involve cash. So they will record only 10,000. So they will record on the another 10,000 when they receive the money from customer. Okay. So it will be maybe 3 months from now, it will be 6 months from now. When the customer pay, then only they record that there is a sale of another 10,000. Okay, so that's a cash basis. Accrual basis means that they will record the account, the transaction when it happened. So for example, in the case of sale of 20,000, where 10,000 is cash, then another 10,000 is credit. So they will record the 20,000 today, Yeah, so which will require them, of course, to record where how it is made. Yeah, and 10,000 is via cash, so which they will also, you know, record a transaction where cash is going into the company of 10,000 because it is by cash, and then where the transaction on credit sale, another 10,000 is credit sale. So they will create an account which is known as a receivable, meaning that an amount which they will receive in future. So that amount is known as, that account is known as receivable. So receivable is one type of account which result from the accrual basis, because it recognize something to be received in the future, the money that we'll receive in the future. So that's it, one of the example and how to explain accrual concept. Okay. So usually, which one is the one that you know, many people use, many company use? Of course, cash basis is not really something that is giving a true and fair view. Yes, for example, like I mentioned, if let's say the company makes sale of 20,000, but they only record 10,000 because another 10,000 is not not paid yet by the customer. So it is not really true about the sale of the company, because the company actually makes sale of 20,000. So that's why the cash basis is only being used by small organization. For example, a club, a badminton club in university, for example, when they receive the membership fee from the members, and then they will record, okay, a membership fee of 10 ringgit multiplied with 100 people. And then from that money they will use to buy, let's say, to buy drinks when they organize a tournament. So they will use the money for to buy drink for during tournament. So all those things happen in cash. So that's why it's more relevant to them. It's more like, you know, something that is easy for them to use. Yeah. So cash basis is always used by small organization, for example, a club, or even a small NGO, where the money, like, you know, they receive today, they will just finish up today as well. So that's the usually being used, how cash basis is being used. Accrual is like something that is what accounting standard is proposing. So in you know, the accounting standard always require that accrual basis to be used, because it is more it is giving a more accurate picture of the transaction. Okay, the difference between this type of accounting is based on when the company actually record the sale. Yeah, i.e. in terms of money inflow, or when they purchase, when they, you know, for example, they use the money, they pay out the money. For example, when they do purchase, when they purchase inventory. So when they purchase inventory, goods coming in, for example, Tesco buying 100 packs of rice. So the rice will be coming, but they are not paying the money yet because they buy on credit. So the amount that they will be paying to the vendor will be recorded as payable. Yeah, so that is actually what being done in accrual basis. They will create an account which is known as payable. So receivable just now for the money that to be received from customer. Payable is for the money that to be paid to the vendor. One of example. Okay, so this is a further explanation on cash basis and accrual basis. The definition for cash basis is it record transaction only when cash is actually received or paid. Yeah. Accrual basis, it record transaction when it occurs, even if the cash is not received yet or the money is not paid yet. All right. So this is accrual basis. Example of situation. I give another example. The company purchased 100 units of product and will pay for it next month. If it is under cash basis, no need to record because it doesn't involve money yet. If it is an accrual basis, so a transaction recorded through an account payable. So because of there is an amount that the company have to pay in future, and then they will that transaction also report that they make a purchase. They purchase 100 units of product, and then the money will be paid next month. So they will create a purchase of 100 units of product, and the amount, let's say 20,000, will be paid next month. So they will create a payable account. Okay, so for this one. All right, and then the company sold 50 units of products and will receive payment next month. So no transaction recorded for cash basis, and then for the accrual basis, the transaction recorded through an account receivable and sale account. Okay, transaction recorded through an account receivable. What does it mean by account receivable? Because they sell something, 50 units of product, and then they will receive the money in the future. So that's why they have to create an account receivable to record the amount to be received, and then how much the things or the goods that have been sold have to be recorded in the sale account. So sale account is an income, receivable is an asset. Yeah, why is receivable is an asset? I already go through with you, right? What does all these type of accounts, the 5 types of account, correct? Okay, let me open the earlier slides. Yeah. Hold on. Okay. Okay, this is the accounting slides number 2, or topic 2, and then I already covered. Okay, I think I stopped at this one, right? What is accounting equation? Hold on. Okay, I already explained about all this. Or not yet. Yeah, this one is not really being explained in detail, I think. Yes, I need to explain all this so that you understand more. Yeah? Okay, let me go back to topic number 2, accounting equation. Because of this important, because of topic 3 is about how to do the transaction. Without explaining this properly, you won't be understanding what does it mean by all those items: asset, liability, equity, income, expenditure, right? So I already explained to you that what does it mean by accounting equation is, a basic principle that explained to us asset will always equal to liabilities plus equity. So asset is what the company own. Asset is what the company own. Yeah, what the company own, and then where the money come from to buy the asset. So this is what the company own, and then this is what the company owe to other parties. So this is what the company own, all the asset. For example, the company own building, the plant, and then all the machinery, the furniture, equipment, all those things are assets. So how they get the money to buy all those assets? They must come from their own money. Some of the money will be contributed by their shareholders, and then another part of it are the money that they owe to the third party. So sometimes there are two main sources lah. Of course, one is from the loan from the bank, or they can also issue bond to get the money, so that using the money from the bond they will buy the assets. Or they can also get the assets from the vendor. For example, the asset that is like the goods to be sold, the inventory, it will come from the vendor, the one that is sell the goods to them. So those are also the source of the source of liabilities, the type of liabilities. Okay, so okay, so this is, I already explained you this one, yeah. Asset are bought or created by the company. It is something giving you the economic value, and that it is bought or created to increase the value, because of if you sell the asset, you can get the money, and then if you have a building, you can occupy the building. And so that's what it meant that by giving value. It can be thought of something that is in future can generate cash flow. For example, if the company sell the goods, so it can generate cash flow to the company. How it can reduce expenditure, because of if the company have their own building, so definitely they can occupy the building without having to rent from others. So that is what it meant by reducing expenditure. And improve sale, of course, when if the asset is about the stocks that they have, or let's say property company is the property that they already built. So when they sell, definitely it will improve the amount of sales. Okay, so I already explained to you the categories of asset. They are short-term, fixed asset or long-term asset, financial investment, and also intangible asset. I mentioned to you a few types of intangible asset, right? The trademark, the trademark, the copyright, even the brand name. Yeah, so and also the goodwill, yeah, where people be willing to pay more for the company. So that is the goodwill of the company. Okay, so and then all these are how it is, how the depreciation being recorded, because of usually assets will have, it will be recorded on historical cost, where it means that from the purchase price, it will be recorded. So any adjustment to it, for example, in terms of how the building is being, more renovated, for example, to be expanded, for example, it has to be recorded separately. And then when there is also the need to record the depreciation, how the wear and tear of the company of the asset, it will be recorded separately as well. Okay. Okay, so this is one of the transaction in asset. So this is important because I want to explain about credit and debit and credit. Okay, so when the company a transaction that is increase in asset. So when there is increase in asset, so when it is about asset and then it is about increase in asset, it should be a debit. It should be a debit to record the increase in asset, right? So example, so the one that will be debited is the asset, and then the one that will be credited is the liability or equity or even the asset itself. So what does it mean? I will explain to you. Yeah. For example, purchase of building at a price of 1 million with a cash down payment of 100,000 and loan of 900,000. Okay, so what does it mean here? The company purchased building of the value of 1 million and then 100,000 is paid using their cash, and then they take loan of 900,000. Here, what is the debited? The account that will be debited is the building, because it is to show that there is an increase in asset. Yeah, and then the increase is 1 million. So another account that will be created will be affected under the matching principle is the cash itself, the cash where the cash of 100,000 which is used to pay down payment. So this is also an asset. Yeah, this is an asset account where to record the building and asset. And then this is the credit is also an asset, which is in the form of the cash that the company used to pay down payment, right? And then another credit is about the loan or liability to third party, to the bank, which the amount is 900,000, right? So here you can see that 1 million equal to 1 million here. 1 million in debit will be matched with the 1 million in credit. Yes, so so the credit can be liability or can be equity or can be cash itself, the asset itself. So here is asset, and then credit can be asset. So how does it, what if the situation is different? Like, the company buy machinery. The price is only 1,000. Small machinery, easy one. Let's say the price is 1,000, and then they pay cash. So it will be, what will be recorded is debit machinery of 1,000, credit cash 1,000, right? So cash is also an asset. Machinery is also an asset. So the debit and credit doesn't mean a different type of account. It can be the same type of account, but to show that at one side debit asset increase, and then it is matched by a decrease in asset when the asset is used to buy the machinery, while the cash is used to buy the machinery. It is also known as transformation of the form, of the asset itself. So asset from the form of cash being transformed to become a building or machinery, in that particular example. Or if let's say they buy a plant, and then they use all the money from investor. Let's say the price is 500,000, and then they pay using the shareholders capital. So the record would be debit plant is like factory, plant of 500,000, and then the credit account would be equity, which means it is actually from the money given by investor. So it can be like that as well. Okay, second type of transaction is a decrease in asset. Decrease. Yes.
Debit is
Yes,
the money that's been taken out, right?
Yeah. When credit was okay. This debit is to show that building is going into the company, that they get a new building. Building is an asset. When they get a building, they will be recorded in debit. So when they in asset, when they take out an asset, for example, they take out cash to pay for the building, they have to be recorded at the credit side, because of it is cash is an asset as well. How to explain this? Okay, it can be in the form of asset. So for asset group of account, for asset group of group of item, for asset group of item, for example, is whether it is cash, whether it's building, factory, or motor vehicle or machinery, all type of asset. If there is an increase, it will be recorded at debit side. If there is a decrease, it will be recorded at the credit side. For example, this one, decrease in asset, it will be recorded in the credit side. Asset will be at credit. So the example is sale of plant. The company sell a plant at the price of 500,000 with a down payment of 200. So here down payment is paid by the buyer to get the plant, and the remaining to be paid within 3 months period. So meaning that the buyer of the plant will pay the remaining 300 in 3 months period. They pay only 200 first. So when the asset is sold, when the plant is sold, it will be recorded at the credit side. The plant is like, the plant is taken out from the company, taken out from the account of the company. So it will be recorded at the credit side. So, but at the same time, it is matched with another creation of asset, whereby the cash, which is paid by the buyer, it will be recorded at the debit side, because when the buyer pay 200 cash, so it will be an addition to asset, an increase in asset, so it will be recorded in the debit side. And then at the same time, they will create another asset, which is known as account receivable. So because of the buyer will pay the rest in 3 months time, it is an account which will be received in future, right? So here is what it is showed here. This is a credit of asset account because of an asset being taken out from the company. And then matching to it is the creation of another type of asset, which is the cash received for the down payment and the amount to be received from the buyer, receivable amount from buyer. So it is also another asset, right? It can be asset credit asset where asset is being taken out, and then it is matched with another creation of asset. Okay. Okay, if what if the situation whereby, okay, let me show you another example. If let's say the account, the sale is done 100% in credit, so it will be like, let's say there is no down payment, so it will be 500 credit, and then 500, another 500 would be receivable, something that receivable. So it is also an asset account. Okay, the next account, the next category of item is known as liability. Liability is defined as a company's legal, financial debts and obligation that arise due to the cost of business operation. Liabilities are settled over time through the transfer of economic benefit, including money, goods, and services. So it's like, it is being solved, being settled when the company deliver the goods to the buyer, or they pay out the expenditure. So those are how it is settled. It is vital aspect of the company because they are used to finance operation and pay for large expansion. And then recorded on the right side of the balance sheet. Liabilities include loans, account payables. Okay, these are all explained last week. Yeah. Okay, I have example as well here, right? So, so when it is an increase in liability, okay, let me explain using this slide. Okay, when there is increase in liability, so the transaction would be at the credit side. Yeah, for liability account, it will be at credit side. So usually the matching would be with the debit in the asset. Because example, a company obtained a 10-year loan from PQR Bank for an amount of 800,000. So here liability increase. So because when liability increase, the transaction is at the credit side, and then what match it is with the amount of money received from the bank. So it is recorded at the debit side for the asset, and then the credit side at the liability. So another transaction is known as decrease in liability. When decrease in liability, so it will be recorded at the debit side. For example, the company paid 100,000 to bank as the first installment. So here the liability decreased because the company paid the bank. And then the one credit would be the asset account because it is coming out from the cash book of or current asset of the company. Okay. Equity is defined as the company owned by, as a capital owned by the shareholders of the company. Equity is represented by the value of an asset less the amount of liabilities. So what does it mean here? If we calculate all the total asset and then we minus all the liabilities, the remaining are owned by shareholders, meaning that it is the shareholders' money, right? So in business, equity is important because it represents the real value of one stake in an investment. So it is the amount of ownership of the owner of the business. So when the company make profit, it will increase equity and vice versa. Okay, so this is how to record equity. Increase in equity. For example, the company obtained proceed from subscription of 2 million of ordinary share at 1 ringgit per value. So what does it mean here is the company issue share to get capital, they issue share and then they sell the share to the public. Let's say 2 million of the share is subscribed by the public, so which means that they have the money received from the investor. Same time they have equity which is created for the investor. So the transaction would be debit current account because they receive money. Current account is the bank account at the bank, yeah. And then the credit would be paid up capital. Okay, when a decrease in equity will be recorded at the debit side. Okay, example is paid 300,000 cash to the shareholders as final dividend. So the debit is the equity, credit is the money because her money is being used to pay the, okay, meaning that the company's money is used to pay the dividend. So which means from current account, from the bank account of the company, 300,000 will be withdrawn to pay for the dividend. Okay. Let me show you, okay, what is revenue. Revenue is the value of sale of goods and services recognized by the company in a period. Revenue also refers to sale or income, which is forming the beginning of the company's income statement, and often is considered the top line of business. Expenses are deducted from the company's revenue to arrive at its profit. So this is what I mean, the matching concept. Yeah, in matching concept, revenue have to be matched with expenditure. Okay, according to value recognition principle in accounting, in the revenue recognition principle of accounting, revenue is recorded when the benefit and risk of ownership have transferred from seller to the buyer, or when delivery of services has been completed. Okay, notice that this definition doesn't include anything about payment for goods or services actually being received. This is because companies often sell their products on credit. Yeah, this is because usually sale is done on credit, meaning they don't receive payment or cash until a later date. Okay, when goods or services are sold on credit, they are recorded as revenue. But since cash payment is not received yet, so there will be account receivable that will be complement the recording. And then when cash payment is finally received, there is no additional income recorded, but the cash balance goes up and then account receivables goes down. Okay, what does it mean here? Yeah? Let's say the company make sale of initially, let's say 20,000, the example that I used earlier, right? So this will be a credit transaction, a credit record. So the one at the debit side would be cash of 10,000, and another 10,000 would be on receivable. So it's already to 20,000 here, 20,000 here. So it's like a balance already, and then it is the matching principle. So when the company receive the payment from this is actually the cash received, right? And then when this is receivable from the customer. So let's say next month the customer pay the 10,000. What will be recorded is Of course, the company receive cash. This is debit. And then the one credit is at the receivable account. Because yeah, it is because now receivable is reduced 10,000. Okay, so that's how to record revenue. Okay, this is an example. Let us see the example. Increase in revenue, which means that the company sell its goods. So example of transaction is, okay, let me take again the, okay, increase in revenue when the company makes sale. So they have to be recorded at the credit side. Yeah, for revenue, when there's increase, it will be at the credit side. So example is sale of good at a value of 400,000 at cash. Okay, sale of goods at the value of cash. All right, and then another one, they make a sale of good at 260,000 on credit to Ali and Sons. What will be recorded here is they receive 400 cash, and then they also have an amount that they will receive in from Ali and Sons. So this is actually one type of one way of recording the receivable. It can be recorded as the name of debtor. The name of debtor, for example, ABC company, or if Tesco bought it from Nestle, so Nestle would be recorded as, or no, Tesco bought from Nestle, so at the account of Nestle, Tesco will be recorded here, so as a receivable, because Tesco do not pay yet the amount of goods for the price of the goods that they bought, they buy on credit. Okay, so the name of the receivable account will be clearly put here, and then cash 400, right? So if you total up, okay, this sale revenue should be, this is mistake, yeah. Sale revenue would be 660, yeah, not 400, because it has to be both. It has to be recorded both, yeah. Let me, so this one, it should be 660. Okay. And then second category, second type of second example is decrease in revenue. When there is a decrease in revenue, the revenue account would be debited. Example, sales return of 50,000 worth of goods due to defect. So the one that being sold earlier now being returned by the customer. That's what it meant by sales return. It will be, it is returned by the customer because of defect. Yeah, due to defect. So it will be recorded like this, yeah. The sale revenue initially 660,000. So now 50,000 of it will be debited because it is a sale return. And then at the same time, the company need to pay back the amount paid by the customer. So if it is a cash sale, if the return coming from cash sale, so definitely the company have to pay back, have to refund the client that pay cash, right? What happen if the amount return coming from Ali and Sons? This is the example, yeah. Sales discount of, okay, if the sale return is done by Ali and Son, yeah. So let's say, yeah, let's say the sales return is done, the sale return of 50,000 done by Ali and Son, meaning that Ali and Son contacted the company saying that, okay, we need to return the product because it is defect. It has a defect. So now here, because of the Ali and Sons do not pay yet, yeah, they are still a receivable. So here is what involved is the credit account receivable lah, or credit Ali and Sons to report that Ali and Sons and the amount owed by them is now lesser by 50,000 because they returned the product value 50,000. Yeah, so what left is only 210 because 50 returned by them. Okay, if that is the situation. Okay, the next one. It can be also decrease in revenue can be also due to the sales discount. What does it mean by sales discount? Usually, company when they sell things to their loyal or regular customer, and then usually they will give like offer that discount of 10% if it is paid within 6-month period. So apart from the customer is regular to them, it is like, you know, like a relationship basis. The discount is given because of relationship. And it is because to encourage the customer to pay early as well. So that's why discount usually given to customer which is with a big amount, because usually they will buy on credit. So that's why the company need to give like incentive that is in terms of sales discount, meaning that if you pay within 6-month period, you will get discount of 10%, 5% like that. Yeah. Example, sales discount of 30,000 given to Ali and Sons for early payment. So what will be recorded here is debit sales revenue of 13,000 and then credit Ali and Sons of 30,000. So what does it mean here is the amount of money owed by Ali and Sons is lesser by 13,000. Okay, so that's in terms of revenue. Okay, now we are talking. I will take you through about expenditure. Usually, business will incur expenditure, various type of expenditure. Yeah, so usually an expense is a type of expenditure that flows through the income statement and is deducted from revenue to get the net income. Due to accrual principle in accounting, expenditure can recognize when they are incurred, not necessarily when they get paid for it. Yeah, the most common way to categorize them is into operating versus non-operating, or the fixed or variable expenditure. Okay, the first type of expenditure is known as cost of goods sold. It measures the direct cost involved with the production of any good or services. It includes material costs, direct labor costs, and other direct factory overhead. And also, and it is directly proportional to revenue. So, which means that this is related to the amount of goods that being sold. As revenue increase, more resources are required to produce the goods and services. Cost of goods sold is often the second line item appearing on the income statement, coming right after sales and revenue, sales revenue. Cost of goods sold is deducted from the revenue to find the gross profit. Okay, SG&A, sales, general and administrative income. Expenditure. Sales as is sales, G is general expenditure, A is advertising. All right, it includes all non-production expenses. So if cost of goods sold is something related to the product, it's directly related to product. Yeah, the sales, generals and administration or even advertisement is something that is not really according to the product that they want to sell. Usually it is like general expenditure happen even though without the sale, the goods managed to be sold, still the company have to incur the expenditure. For example, as general expenditure, the salary of the secretary at the boss office, at the office of the bosses. So their salary is considered general expenditure. Okay, so general expenditure include rental, advertising expenditure, marketing, accounting, litigation. Litigation means, you know, court case, travel, meals, management, salaries, bonus, and more. Okay, so that's what it meant by sales, general, and administrative. Okay, another type of expenditure is known as depreciation. I already mentioned to you the word depreciation. It is used to allocate the cost of tangible asset over its useful years, useful life. In another word, it is reflecting the group, the value of asset that occur over time due to usage, wear and tear, and obsolescence. Okay, how to record expenditure? So increase in expenditure will be recorded at the debit side. Yes, so increase in expenditure will be recorded at the debit side. So it usually being matched with either asset or liability or even equity. This example, for example, depreciation expenses on machinery of 30,000. So the depreciation is a debit, depreciation expenses, and then the credit side is, remember it won't go to the machinery. The machinery won't, for example, the machinery were bought at the price of 1 million, 1 million. And then it won't be like, it won't be like credit the machinery won't, it won't be like that. It will be recorded in accumulated depreciation. So meaning that, let's say for the first year, the depreciation is 30,000. And then the next year, another 30,000. So the 30,000 will be recorded as expenditure for that particular year. However, the accumulated depreciation is something that is recorded, but it will be deducted from the asset account. For example, machinery 1 million. So now 30,000 has been depreciated. So it will be left with 900. 1 million, for example, will be left with 970 because 30,000 has been depreciated. Okay, the second example is increase in expenditure. Again, debit expenses account and credit liability. So what does it mean here? Utility bills accrued 1,005. And then because of that, it will be debited with the bills account, which is 1,005. And then another account that will be matched with it is the credit side of payable, because of it is need to be paid. Okay, the last one, transaction, which is increase in expenditure. Again, so it will be debited. Example, administrative expense and cash of 1,500. So it will be recorded as debit of administrative expenditure and cash of 1,500. So meaning that they pay cash 1,500 because of it is paid cash. All right. So that's about how to record the all the financial transaction. Okay, so let us go back to the third topic. But before that, let us take a break. Let us take a break for 15 minutes. We come back at 10:50. We come back at 10:50. All right. So let us take a break for 15 minutes. Come back at 10:50. Let me share the slides first. Okay, so I will stop here. And then let us take break until 10:50, okay? I stop recording now. Okay, so this is actually from slides number 3, topic 3, where we talk about the transaction analysis and account recording. Okay, so these are the 5 types of accounts that I already presented just now: assets, liability, equity or shareholders' equity, revenue, and expenditure. So now I want to explain from a different perspective. Okay, so asset, liability, and equity are the main account in financial statement called the balance sheet. So the three types of it, yeah, asset, liability, and shareholders' equity are the main accounts in a financial statement called the balance sheet, or another name of it is statement of financial position. The balance sheet shows a company's financial position at a certain point of time. So a statement of balance sheet, another name of it is statement of financial position. It's showing the company's financial position at certain point of time. That's why previously it is known as balance sheet, to show that it always balance at the asset side and plus and the side of liability plus equity. So it has to be balanced at both sides, right? So that's why it was known as balance sheet, because it shows a sheet which is a balance, which is at one side it is an assets, and the other side it is liability plus equity, to show the accounting equation. So it balanced. That's why the name was balance sheet. But now the name, the official name for it, the one that is being used by companies in their financial statement, in their annual report, is statement of financial position, because it is showing the financial position of the companies at certain point of time. So as I explained earlier, asset include everything that the company owns. For example, the cash, inventory, building, equipment, or automobiles. Liability are something that company owe to others. For example, bank loans, vendor bills, or utility bills. And then the equity includes whatever the owner have claim on that particular company, on the assets of the company. So what the shareholders ownership in that particular assets. All right. Okay, let me put on the charger first. All right. Okay, now it is the revenue and expenditure. Yeah, I already explained about the three: asset, liability, and equity. So now it's about revenue and expenditure. Revenue and expenditure is the accounts in which is which will be exist at the income statement. So income statement show the company performance for a certain duration in time, usually fiscal year from January to December. So usually when bookkeeper record transaction, multiple accounts are affected, whether they are different account, asset, liability, or within the same general account. So for example, the one that I mentioned, it can be from the same category. It can be from the asset type of account. For example, when the company use cash to buy machinery, so it will be a same type of account, because both accounts are from the asset category. Machinery is an asset, it is debit, and then when it is credited, it is also an asset, which is a cash. Cash account will be credited to show that the cash is used to pay off the purchase of machinery. Okay. Okay, let me turn on the charger first. Yeah. Okay, let us continue. Okay, so this is the accounting equation. Yeah, again, to refresh you on accounting equation, this is very important principle, so that you understand how to record it. Why the matching principle is important. Because matching principle is also explaining about this. Yeah, where for example, when the company purchase asset, the matching account would be either liability, or either equity, or even either the asset itself. Yes, so that's what it meant by why the accounting equation is so important. So again, asset, liability, equity. So asset is the economic resources, while the liability are obligation and where the sources of fund itself coming. coming from, yeah, whether it is obligation from the third party or it is the owner's claim on that particular asset of the company. Okay, I already explained all this, right? Okay, these are also explained already. Okay, now what I want to show you is this one, yeah. This is the description of transaction. This is where we stopped actually last week. Yeah, the description of transaction. So this is assuming a small entity which is just set up by Nazrin. Yeah, the entity is about training and consultancy. Just like you just imagine Sharia advisor in IBF, you know, then they or the Sharia advisor to bank or Sharia advisor to capital market. So they will among the activities that they have is giving training and giving consultancy. So those are what being done by Nazrin. Yeah, you assume Nazrin is a person who have Sharia background and she is, you know, providing service to financial institution, Islamic financial institution. She give training and also she give the consultancy service. So now she established a company. Yeah, Nazrin transferred 50,000 into the firm. So Nazrin is the founder. She is the shareholder as well. So she transferred 50,000 into the firm, into the consultancy firm. And then on June 5, 18,000 is paid for advance rental of the office. So meaning that the money put by Nazrin is used to pay advance rental of the office, so of the company. Yeah. So Nazrin is the owner. Nazrin is a third party. So Nazrin is owner of the, not the third party. Nazrin is the owner of the company, right? So Nazrin put 50,000 into the firm. And then from that money, the company used 80,000 to pay advance rental to the office. So meaning that they pay advance rental, monthly rental is 3,000. So which means that this 18,000 is for 6 months. Yeah, 6 months. Monthly rental is 3,000. And then on June 30, the company paid 2,000 to the personal assistant. So from the money as well, from the 50,000 put by Nazrin, the company used 2,000 to pay for the personal assistant. Yeah, of course, the firm need somebody to manage the running of the office. So they engage personal assistant, meaning that Nazrin engaged personal assistant, and then she paid 2,000 to the personal assistant. And then she paid 500 for the utility bills. And then on July 1st, she provide training at ABC Bank. She provide training at ACBC Bank. And then she got an invoice submitted to the firm for 4,000 ringgit fee. The fee of training is 4,000. And then on July 3, rental payment incurred. Yeah, so she paid rental in advance, where of course she will this rental advance rental is the category of what? Asset. Yeah, advance rental is an asset to the company, because once they pay the rental, advance rental 18,000, they can occupy the building, they can occupy the office. So now in July, rental occurred. So meaning that now rental incur, so they have to utilize the advance rental. Yeah, they have to utilize the advance rental. Okay, let me show you here. Yeah, so easy for you to see the implication of the transaction. It is the same one, yeah, the same one, but here I'm showing you what accounts are affected. Yeah, please make sure you understand, and then ask question. Okay, the first one where Nazrin transferred 50,000 into the firm. What happened is there will be cash into the company, 50,000. Yeah, so it is an addition to the cash. Of course, in the beginning, the cash account is 0 because it is a new established firm, right? So when Nazreen put it 50,000, so there will be 50,000 into the company's cash, and then the company will create an account which is called equity, to represent equity owned by Nazreen, to represent ownership owned by Nazreen. So which is 50,000 in cash as well, yeah. So but it is recorded as equity to represent ownership of the Nazreen in the company. So now on June 5, when the company pay 18,000 for advance rental, and it is recorded as well, monthly rental is 3,000, but it is not happening yet. The monthly rental is not happening yet. But what happened is the company pay 18,000 in advance. So of course it will be a reduction, yeah, a reduction of 18,000 here. 18,000 is reduction of the money from 50,000 earlier. So negative 18,000 is reduction of money in the cash of the company. So now it will be, the matching account would be advance rental. So another asset category, which is advance rental, is created. So here the matching is in the category of asset. Yeah, asset minus 18,000, asset increase 18,000. So this is to record that it is an asset being created, whereby this will enable the company to occupy the building or the office for 6 months. So this is the amount of 18,000. And then on June 30, when the company pay 2,000 for personal assistant. So the 2,000 will be, of course, reduction of cash, yeah, the reduction of cash. And then here you cannot see, yeah, because of there is another page whereby the income and expenditure account will be shown, yeah. Yeah, so you see here, right? Transaction number 3, yeah, paid 2,000 to personal assistant. So the first transaction would be, the first record would be minus 2,000, yeah, minus 2,000, because it is a reduction of cash. And then the matching is at the expenditure, yeah, the matching is at the expenditure, whereby here, yeah, all these are all the expenditure account, and then the account that is related to the transaction is the salary of the personal assistant, which is 2,000. Okay. Okay, let us go back to the previous page. Right here, another transaction happened on June 30. The company pay 500 for utility bills. So now again, 500 is a reduction of cash because the company pay using cash 500. So this 500 for the utility bills. Utility bills are one type of expenditure as well. So let us go to the next slide, where it shows the expenditure account, yeah, for this particular transaction, 500 for utility bills. So it will be recorded at the utility bills, yeah, 500. Okay. So the next transaction, again, we go back to the previous slide. Provide training to ABC Bank, invoice submitted 4,000 fee. Yes, so meaning that the company submit invoice to the bank to charge the bank 4,000. So now, yeah, provide training is actually a transaction which is related to the sale of the company. The company is doing service, yeah, they don't sell goods, they sell the service. So it's this type of sale or income. So next slide will show that, okay, at the income category, there are 2 activities or 2 accounts. It is about training and advisory service or consulting service, advisory or consulting, and then also training. So the first one, provide training ABC Bank, it is a training coming from the training activity, which is 4,000. So now the 4,000 is a receivable from ABC Bank, which means that they already give invoice to ABC Bank. ABC Bank will pay in future. So they will receive the amount from ABC Bank in future. Yeah. So it is an asset. Okay, the next one, rental payment incurred. So what happened now? They have to recognize that the 3,000 in the advance rental is utilized. Yeah, initially it is an asset, which is the value of 18,000 to be utilized for 6 months, 1 month 3,000. So now the first one incurred. So they have to recognize that now the asset is reduced by 3,000 because it's being utilized. And then the matching is at the, of course, expenditure to recognize that it is a rental expenditure. So let us go to the next slide to show the expenditure side. Yeah. So the rental is here, this one, yeah, 3,000, which is rental. And then the matching is reduction in advance rental. Okay, the next one, again, Nazrin provide trading at ABC Bank. Invoice submitted for 4,000. So again, another training is given to the ABC Bank, and she submit invoice, or the company submit invoice to ABC Bank, another 4,000. So here another 4,000 going into ABC Bank receivable from ABC Bank, another 4,000. And then this is an income or a sale activity, which is an income for the company. So let us go to the next slide to see how the income account. Yeah, again, from the ABC Bank, another 4,000. The next transaction, provide advisory to Zakat Authority, invoice submitted for 5,000 fee. So this is the consultancy given to Zakat Authority. The amount is 5,000. Yeah, this is an income. Yeah, but cash is not received yet. Yeah, they submitted invoice. So again lah, we have to look at this one. Yeah. So where it exists, it is another asset receivable, which is receivable from Zakat Authority, 5,000. Okay. The next one, provide training to another bank, which is XYZ Bank, and then invoice submitted for the 4,000 fee. Again, yeah. Provide training. So this is another receivable, XYZ Bank, 4,000. And then the matching is again training, 4,000. Okay, another 4,000 for training. Okay, and then at the end of the month of July, again the company have to pay 2,000 to personal assistant. This is the expenditure salary to the personal assistant, salary 2,000. So of course the matching is the credit of cash, yeah, credit of cash, which is here, cash, which is 2,000. Okay, so this is the previous page, yeah. Okay, and then another one, paid 500 for the bill, for the utility bill. So again, this is a reduction of cash, 500 ringgit. And then the matching is at the, here, yeah. The matching is utility bills, 500. Okay, so now what happened is the next transaction, receive 8,000 from ABC Bank for the training fee. So now the ABC Bank paid the amount that they owe to Nazrin. Yeah. So it will be, of course lah, cash coming in. Yeah, cash coming in 8,000. And at the same time, we have to recognize, yeah, the 8,000 coming from ABC Bank. Yeah. So now ABC Bank, as the amount receivable, which is 8,000, already has been reduced by 8,000, meaning that the amount is eliminated. Yeah, so at the, this one of course lah, at the credit side lah, this one is debit side, this one at credit side. Of course, when debit credit 8,000, meaning that no amount balance, yeah, for this particular level at this particular moment. Okay, August 3, rental payment incurred. Again, now it is a reduction of advance rental, meaning that advance rental is utilized at the amount of 3,000. And of course, this is another rental expenditure will be recognized. Yeah, another rental will be recognized. Next transaction, yeah, it is about receive 5,000 from Zakat Authority. Yeah, so Zakat Authority pay the amount that is submitted by Nazrin, which is 5,000. So it's cash coming in to the company. And then at the same time, we have to recognize that the amount receivable from Zakat Authority is reduced from 5,000 earlier, yeah, now reduced by 5,000. Okay, so now at this moment, no more balance, yeah. The next one, Provide training at ABC again provide training to ABC, invoice submitted another 4,000. So now another invoice submitted, another receivable amount is created at ABC Bank. So ABC still owe another 4,000. So this is again an income, an income to the company, under training. So next one, engage Amal Creative for online learning program, receive invoice of 9,000. So what is this? Amal Creative is the one doing online learning. So they are using all the cartoons, all the apps to come up with the learning content, because Nazrin is the one providing training, right? So now she appoint Amal Creative to develop the online learning program for her, and then she want to pay Amal 9,000. She want to pay, but not paid yet. Not paid yet. That's why she received invoice of 9,000. So when she received invoice, so what the account being created is, first is the asset account, which is the training material. Training material is an asset to Nazrin firm. So this is 9,000 on the asset is training material, because their products is training and advisory, right? So training material is their asset. So now the amount she owed to Amal Creative is the liability or payable. Payable Amal Creative. It is a form of liability account, 9,000. So now on August 27, the firm paid, Nazrin firm paid 1,002 to Extravaganza Cafe for client networking. So a few clients come to the office, and then the office take the service of Extravaganza Cafe to order food worth 1,002. So this money is expenditure, expenditure, and then it is a reduction of cash of 1,002 because they paid cash. So this is expenditure, another expenditure which is under the category of entertainment, or client networking can be used also that name, 1,002. And then the next one would be paid 2,000 again at the end of the month of August. Again, she has to pay the personal assistant of 2,000. Again, negative credit at the cash account of 2,000. And then this is again to have to recognize the matching is the salary of 2,000. And then the last one, paid 500 for utility bills. 500. So it is another additional of, for the utility bills, another 500. So this is the matching one. Of course, the cash, which is reducing by 500 because the money is being used to pay the utility bills. All right, so let's say only 3 months, and then Nazrin want to close the account. Bukan not close the company, but close the account. She want to calculate how much profit she make for the 3 months period. Okay, so now what we can we have to do is we have to total up or balance up the account. We have to close the account, all the accounts. So now cash account, how to close? We add all this, 50 minus 18 minus 2 minus 500 minus 2,000 minus 500, and then add with 8,000, add with 5,000, and then minus 1,002 minus 200. Okay, when you do that, the answer is, the final balance is 36,300. Okay, this one also do the same, 18 minus 3 minus 3, so 18 minus 6 lah, so the remaining is 12,000. Okay, so and then this is 4,000, 4,000, 8, 4. So what left is 4,000. This one no balance, 5 minus 5, no balance. This one 4,000, still balance. And then this one 9,000, still balance 9,000. Okay, so if you look at the asset category, when the balance is positive, it means that the balance is at debit side, because of when it is positive, meaning that there is actually an increase in the value of asset, the asset account, so increase in asset account, so at the debit side. Okay, and then liability, Liability, when the so here 9,000, there is no other transaction, 9,000, and then this one is 50,000. So for liability and equity, when the number is positive, it is at the credit side. Yeah. So again, you have to remember, this is the accounting equation, meaning that you have to still remember that asset always equal to liability plus equity. So if you look at this, this is the liability and equity, and then it should be at the other side of equation, which is at the credit side. So when it is a positive answer, it is at the credit side. For the asset, when it is a positive answer, positive figure, then it is at the debit side. Okay, so this is the income and expenditure. For income, when it is an increase in income, it will be a credit side. So for the expenditure, when there is a positive amount, it is at the debit side. Yeah. So for income, when it is happening, it is at the debit side. All right, because income at the credit side. So when it is a debit, it is like reducing the income. So we total up all the account again. We close all the account. Advisory 5,000, training 4,444, 16,000, salary 6,000. This one 1,005. Entertainment 1,200, and then rental 6,000. Okay, now what we have to do is we have to prepare the profit and loss. Okay, profit and loss account. So first, income. What are the type of income that they have? Training and advisory. 16,000 plus 5,000. So total income is 21,000, right? So these are all the expenditure. Rental 6,000, salary 6,000, utility bills 1,005, entertainment 1,002. So total expenditure is 14,700. So what is the profit of the company? 21 minus 14,700, 6,003. Yeah, so meaning that the company made profit of 6,003 in 3 months period. Okay, so now this is the statement of changes in equity. Yeah, if you still can remember the type of financial statement that I show you, statement of changes of equity is showing how much the balance of equity in the beginning of the period and how much the amount will be at the end of the period. So now the beginning of the period, the amount is 50,000 when Nazrin put the money in, and then the profit given by the business for 3 months is 6,003. So we just add with profit of 6,003, meaning that every time the company make profit, it will enhance the shareholders' equity. So it is like this is belong to the owner, which is now Nazrin. Yeah. So Nazrin initially put 50,000, so she can claim on the company's assets the value of 50,000. And now when there is profit, she also entitled to claim for this profit as well. So that's why it is included in the equity. So now at the end of the period, the equity total is 56,300. Okay, now we are preparing statement of financial position as at August 31st, 2018. So now this is the balance from the accounts that we prepared just now when we do the balance. Cash 36,300, advance rental 12,000. Receivable from ABC company, ABC Bank 4,000, Zakat Authority no more balance, XYZ Bank 4,000, and training material, which is an asset as well, 9,000. So these are the total of the asset side, 55, 65, 300. So now at the liability plus equity, the liability is only payable to Amal Creative, which is 9,000. And then now equity side is 56,300, the one that we from the statement of equity just now. So this is the equity side, 56,300. So now total equity would be 56,300, and then total liabilities would be 9,000. So the total is 65,300. So if you look at this total and this total, the assets, the total of asset, total of liability plus equity, It is balanced. It is equal. Yeah, so that's what it meant by statement of change. Statement of financial position, or our balance sheet. Yeah, because of it is reflecting the accounting equation. So this means that after every transaction, you will see that the amount at the asset side will always equal to the liability plus equity, because to some portion it will give impact to equity part as well. Okay, any question? This is actually the three financial statement, which is the statement of income, statement of changes in equity, and statement of financial position, right? So this is actually the question that's given in the assignment. You know, this is how to prepare financial position. You have to make sure that asset always equal to liability plus equity. And then the second is the number 4, question number 4 is about this. You need to prepare the income statement. Any question? Munira, any question? It's very sleepy, right?
No, it's very interesting. Like,
Okay, but I have to admit that I myself very sleepy just now. That's why the break give me time to regenerate. So I went to water my plants outside. Then only I'm a bit fresh. Because before break I was so sleepy. I have to be frank with all of you. So hopefully all of you understand. Mahmud, how is it? Understand?
Yeah, doctor, but I was
Still
sleepy.
struggling to understand. I can understand, yeah? So
Yeah,
how is it?
It's okay.
it's good, inshallah. But
Okay, but okay, yeah, you can understand Mahmud. Okay, what about Sundus?
It's okay, doctor.
All right. Okay, Mahmud.
Assalamualaikum. It's okay.
Okay, Alhamdulillah. Yeah, this is actually, of course, a simple example of how all the transaction is being recorded. And finally, yeah, the one that I show you, it is how transaction is recorded. Now, how transaction is recorded, it is at either every transaction will give impact either at the asset side, and liability side, equity, or income or expenditure. It will give impact to any of the 5 category. Yeah, this is the common. This is something that this is one way to understand accounts, whether it is an expenditure, whether it is an income, whether it is an liability or equity, or whether it is an asset. So once you understand this concept, when you look at the account financial statement, you can understand what does it mean. Yeah. Okay, so let me, if there is no question from here, do you want to continue? I believe with this, you can do the assignment already. Or let me see the next topic 4. Yeah? What will be the content? Yeah, this is actually how to prepare the same one actually. Yeah, let me open the slide first. It is actually the same. All right, so let me share. Okay, let me share the slides. Okay, so the title of the topic is, hold on. Can you see the slides? Hold on, yeah. Let me close first the rest. Okay, so the title for this particular topic is Trial Balance and Financial Statement for a Corporation. So again, this is actually showing how to prepare the financial statement. So we just did that. Yeah? We just did that before in topic 3. What we did is we already prepared the financial statement. Okay, I have to stop the first, yeah, the animation. Okay. So what we did earlier, we also prepare the financial statement. Yeah, what we did earlier is we prepared the financial statement for Nazrin. Yeah, we use the information. First we record the transaction, and then after that we prepare the financial statement. What we didn't do is we didn't do the trial balance. Yeah, actually trial balance is a sheet. It's a sheet where company will prepare before they transfer the information to the financial statement, yeah, into the 3 financial statement, and the statement of financial position, the statement of comprehensive income, and the statement of change in liquidity. So they will prepare trial balance first. Yeah. So what does it mean by trial balance? It is a sheet of paper. It is a one document where it is showing all the list of accounts at the debit side and all the list of account at the credit side. And then they will total up everything to see that whether it is balanced or not. So when it is balanced, so it is an indicator that the transaction is correctly done, and the transaction is correctly recorded in the financial statement. Okay, so and this is what you will learn, yeah, from this particular topic. It is actually almost similar to what you already did just now, but this is to explain further the process. Okay, so you will understand how the account is prepared, how the financial statement is prepared. I will go very fast, 30 minutes inshallah, so that we understand what is being discussed in this topic 4. So you will understand how the financial statement are being prepared. So we did already just now for Nazrin, we already prepared the financial statement from the record of transaction that we did earlier. So, and then recognize importance of trial balance in the preparation of financial statement and identify items reported in the financial statement. And finally, explain the bottom line of income statement and balance sheet. Okay, this is about trial balance. Trial balance is a bookkeeping worksheet in which the balance of all ledgers means all the accounts. Yeah, when I show you the category of account and the asset, for example, cash, advance rental, and then cash, advance rental, and then training material, receivable. All those are the one that related to Nazrin is receivable ABC Bank, receivable Zakat Authority, receivable from XYZ Bank. All those are known as ledgers, yeah, or accounts, yeah, accounts or ledgers. So meaning that every individual transaction we will create a special account for it, a special ledger for it. So balance sheet, trial balance is a worksheet where all the accounts or all the ledgers will be listed down according to its category, whether it, and then the total is ensured at the right category of whether it is debit or credit. So after that, it will be, once the list is done, then it will be total up to see whether both side debit and credit are equal or not. It should be equal, yeah, because of the way we record it. If you can relate to the one that I showed you, yeah, every time I record the transaction, for example, salary of the personal assistant 2,000, credit the cash 2,000, and then debit the salary 2,000. So it will be the same amount, but will be recorded one at the credit side, one at the debit side. So because of that, supposedly trial balance is, will be balanced at the credit and debit, will be at the same value at the credit and debit because of the way we record. It should be implicating at least two accounts in the debit side and credit side. So because of that, trial balance should be balanced. However, there are cases where when the recording is done inaccurately, and then the trial balance won't be balanced. That's why trial balance is one of the tests to see whether the recording is accurate or not. Yeah, so usually trial balance is prepared at the end of reporting period. So meaning that example, Nazrin just now, after 3 months, she already want to close the account, she can prepare trial balance before she do the financial statement. Okay, so it has to be prepared at the end of the period. This is actually the preparation of trial balance is to detect any mathematical error that have occurred in the double entry accounting system, because accounting system is about double entry. It has to be whether debit this account, credit that account, yeah, debit asset, credit liability, or debit asset, credit equity. So it should be either one of it. Yeah. So because of that, if the trial balance is not balanced, means something wrong with the recording. So that's why we have to do trial balance. If the total debit equal to total credit, the trial balance is considered to be balanced, and there should be no mathematical error in the ledger. Okay. Okay. However, if the transaction is wrongly classified, or if the bookkeeper missed out the transaction, then definitely the account will still be the trial balance will still be balanced. So those are the things that result in maybe we cannot detect that there is a wrong inaccurate record because of, let's say, if the bookkeeper forgot to record the transaction, so definitely it will be out of the list at both sides, debit credit, so it won't be detected at the trial balance. Another example, if the transaction is wrongly classified, yeah, but it is still at the credit side, for example. Okay, one good example is stationery. Do you know stationery? All the pencils, pen, and then now we don't use pencil, pen anymore. We are using like printer, ink. Because every time we use computer, we need a printer, ink to print. Yeah, so or even the the scanner machine is one of the stationery, or paper, the printing paper. So all those are stationery. Okay, stationery is, in normal companies, stationery is an expenditure. Yeah, in every company, stationery are expenditure because it is something to be used in the operation of the business. Okay, but there are companies who can recognize the stationery as their asset. Example are the company that sells stationery. The company that sells stationery, the stationery that they bought is their asset, is their inventory, because of asset in the form of inventory, because they need the inventory to be sold to the customer. So they will buy first the stationery from vendor, for example from Pilot, or from what's the other brand name of stationery, Stabilo, yeah, or Parker, shop like bookshop like MPH, what else, yeah, in Malaysia, MPH, or what else, the name of the bookshop that anybody?
Popular.
Kuniya, is it? Forgot already. Yeah, Kuniya. Kuniya is a big shop in the KLCC, and then it's international brand name. Yeah, Kuniya, for example, it has a section that sells stationery. So definitely before the company able to sell, they have to buy the stationery first. So for a company like Kuniya, definitely when they purchase stationery, the stationery partly is their expenditure, partly is for their own use for the business, and another part of it, the big part of it, is for their inventory, the stock of item that they want to sell to the customer. So this is, when it is classified wrongly, and then it still can give a trial balance which is still balanced, because for asset, inventory is an asset, right? For an asset, when there is an addition of asset, when they buy the asset, it will be at the debit side. And then expenditure as well, when it is recorded as expenditure, it is also at a debit side, because both at debit side. So that's why the wrong category of asset in this particular example is stationery, which, for example, Kuni-Kuniya, supposedly it is recorded at the asset side, but due to some reason, the bookkeeper wrongly recorded at the expenditure, which is also a debit side. Yeah, so it is recorded at the expenditure. So it won't be detected by the trial balance because both are at the debit side of the accounts. Yeah. So this is one example that cannot be detected. Yeah. So that's why the role of auditor, they need to really go through all the invoice, and they need to be able to identify where the recording is done wrongly. Okay. Okay, so this is the statement of income, or the statement of comprehensive income. Yeah, income, or the statement of profit and loss. Yeah, also known as profit and loss or statement of revenue expenditure. It is one of the three major financial statement of the company's annual report. So all public companies must submit 3 legal documents to the regulatory body and their investor. The 2 financial statement are balance sheet, or the statement of financial position, or statement of cash flow, right? So it is a requirement. For example, in Malaysia, we have, when the company is established, the company have to register themselves with the Companies Commission of Malaysia, CCM. Yeah, CCM. That one is to get themselves registered and established. And then after that, let's say they grow bigger. Okay, when they started, yeah, the first year they have to submit annual report. Yeah, and the first year they have to submit annual report. And usually, if they are registered as a company, as a corporation, they have to get auditor to verify their financial statement. And then they have to lodge the financial statement, or they have to submit the financial statement to the Companies Commission of Malaysia. Yeah, so in the first year of establishment. So, and then the following year also, they have every year at the end of their financial year end, they have to prepare the financial statement, get auditor to verify, and then after that they have to submit to CCM as well. Yeah. So that one, when they are small base. When they are going big, let's say they are going big and then they want to get listed on Bursa Malaysia, becoming a public company, for example. So when they are a public company, usually they are much bigger than the one that is not listed. Yeah. So when they are big, and then they are listed on Bursa Malaysia, they have another responsibility. Not only the CCM, Companies Commission of Malaysia, they also have to submit their financial statement to the Bursa Malaysia, as well as the Securities Commission of Malaysia. Yeah, these 2 regulatory body are the one monitoring their activities, and they have to submit annual report to both parties as well. So now they have 3 obligations: one to the Companies Commission of Malaysia, second to the Bursa Malaysia, the third one to Securities Commission. Okay, so they have to submit to the 3. All 3 provide investor with information about the state of the company. All 3 means all the financial statements. All the 3 financial statements, the statement of income, statement of financial position, and statement of changes in liquidity. All the 3 statements provide investor with information about the state of the company's financial affair, but the income statement is only one that summarizes the sales and net income. Okay, for the statement of income, it shows the summary of sales and the expenditure and the net income as well. Okay, does the profit represent cash available in the company? This is a question. Anybody? Does the profit recorded in the statement of income, does it represent the cash available in the company? Anybody can answer?
No, madam.
No, yeah, correct. Why? Why it is not actually similar? It is not equal to the cash available in company.
Because profit is the total cash minus by the cost.
Okay,
Yeah.
okay. How to explain this is, okay, Munira, if you remember the accrual basis, then the profit is actually the outcome of revenue or sales or turnover minus the cost of goods sold. Remember, sales in the financial statement of income, usually the first one is about sales, how much turnover, right? And then how much, or sometimes it is known as revenue, or sometimes it is recorded as income. Yeah. So all these are what the company got from their activities, right? Whether it is recorded as revenue, sales, or turnover, or it is the same thing. It is referring to the amount of sale, whether they sell product or whether they sell service. And then these sales, if you remember, it is not 100% on cash, right? It is not 100% on cash. They are sales which is done on credit basis. If you remember what happened to Nazrin firm, some of the the training activities is not being paid yet. Some of the so the same goes to the companies like Nestle. When they sell to Tesco, not everything is paid by cash. So this revenue or this sales or this turnover amount is not actually 100% cash. Yes, most of them will be on credit terms, which means that it is an amount to be received in the future, received in terms of receivable, not actually in terms of cash. Yeah. And then after that, after they record the sales, and then after that, what they have to do, they have to minus the cost of goods sold. Cost of goods sold. In the example of Nazrin, we don't have the cost of goods sold because Nazrin's activity is service. It is selling the service of giving training and also giving consultancy. But for companies that involve production, for example, Nestle, that involve production of food and beverages, they definitely have cost of goods sold. So they have to deduct the cost of goods sold first. Yeah. Again, cost of goods sold also involves something that is not paid yet. Yeah, especially the item that they bought from the raw material that they bought from vendor. Not everything is paid by cash. So again, this one is not actually about cash transaction. So when they calculate this revenue, sales, or turnover minus cost of goods, so what they get first is the gross profit. If you can relate the financial statement of Nestle, yeah, gross profit from here. And then after that, when they got the gross profit, what they will have to minus further is all the other expenditure. For example, the sales, general, and administrative expenditure. And then what else? The finance costs, all the other expenditure. Then only they will get the net profit. Net profit. So the question by this particular lady is whether the net profit here is equal to the cash available in the company or not. Yeah. So Mudira already answered not actually. So the reason why it is not the same because of net profit here is not made up of cash alone. It is involving the amount to be paid, involving the amount to be received in future. So that's why it is not equivalent. Yeah, that's the answer. Okay. All right. So this one I already explained. When we do sales, yeah, sales recorded once the company actually deliver the product or services to the company, to the customer. Yeah, sales is recorded when products are sold to the customer. So whether it is cash or credit, once it is occur, then they have to record. So the company usually allow customer to return the product if there is any defect. Yeah, the amount of product return will be recorded as sales return, which will be deducted from the sales amount. I already show you the example, right? And then the company also usually offer discount if the company pay, if the customer pay within certain period, right? Just like example that we see earlier, yeah, the discount given to the customer because the customer pay early. And then again, this will be deducted from the amount of sales. So the net sale is the result of sale then minus return, minus discount, then we will get the net sales. So usually big company, when they sell products, then they will have this sales return and sales discount. Yeah, from the Islamic perspective, Sharia perspective, it is like the company is providing the khiyar al-aib, yeah, khiyar al-aib, whereby when they sell the product, they give the option to the customer to return if there is any defect. Khiyar al-aib, so within 30 days, for example. So when the customer return the goods, so definitely they have to reduce the amount that they recorded earlier. Yeah, so if the customer pay by cash, they have to refund the cash. If the customer do not pay yet, the amount is recorded in receivable. Of course, they have to reduce the amount of receivable. They have to credit the receivable account to show that the amount is reduced. So now customer have obligation to pay and the company have the right to collect the payment from the customer. Okay, so this is where the account receivable is generated. Yeah, so the balance of account receivable will appear as an asset in the balance sheet or in the statement of financial position. Okay, cost of goods sold. So I mentioned about cost of goods sold. Usually companies that produce goods, they will have this cost of goods sold. It is actually about all the costs involved in acquiring or manufacturing the products that the company sells during the period. So it is about the cost related to the product that being sold only. Okay, not the product which is not being sold. It is about the product that being sold. Why it is only about the product being sold? Because we want to know how much the cost for the product that being sold. You know, let's say we are recording the amount of sale item, the amount of being sold to the customer, we record that as revenue to the company. So now what we want to know, how much is the cost of that product that being sold, so that we know the profit, right? So usually it include the cost of labor, the cost of material, and the manufacturing overhead. Manufacturing overhead means all the fixed costs. All the fixed costs, for example, utility bills, all the salary of the administrative officer, the rental of the building, all that. Yeah, so those are the overhead. For example, the cost of goods sold for an automaker would include the material cost for parts that go into making the car. Yeah, for companies that sell car, so they have to, of course, the cost of goods sold include the price of the parts which make up the car. Yeah, and then the labor cost. And then the cost of sending the car to dealership and the cost of labor used to sell to the car would be excluded. So what does it mean here? There are another cost involved with the car, the production of car. For example, the cost of sending the car to the dealer. That one is different cost, not cost of goods sold. That one is the administrative cost. That one would be, for example, this one, labor used to sell the car. You know, the salesperson have to sell the car, so that one would be under the sales expenditure, not cost of goods sold. Yeah, cost of goods sold is only directly related to the production of the goods, yeah, alone, just like cost of labor, materials, and overhead. Okay. All right. So furthermore, costs incurred on the cars that were not sold during the year will not be included when calculating COGS, and whether the costs are direct or indirect. Okay, what does it mean here? As the one that is related, the cost related to the car which is in the showroom, not being sold yet. Yeah, so that would not be included in the cost of goods sold, because cost of goods sold only about the cost which involved with the goods that being sold only. So in other words, cost of goods sold include the direct cost of producing goods or services that were purchased by customer during the year. Yeah, so it's already being and then after the sales minus the cost of goods sold, what we got is gross profit. So gross profit is the amount left over from sale after cost of goods sold is subtracted after deducting the cost of goods sold. So it is sometimes called gross margin or manufacturing margin. Yeah, it is sometimes known as gross profit or gross margin, or the profit from manufacturing activities, manufacturing margin. So it is like this, yeah, sale minus cost of goods sold, then what left is profit. So I already show you other income, yeah. Other income is about, okay, other income, it does not, is the income that does not come from company's main business. So the sales, usually when we report the sales, should be on the items which is related to the main activity of the company. For example, Nestle, the income, the one that recorded as sales or revenue or turnover is the one related to the product, to the sale of food and beverages only, the main food, the main product. However, if Nestle got the rental from the building, Nestle got a big building and then they rent it out to some other companies, that will be recorded as other income. Example of other income include rental income and profit from foreign currency exchange. Yes, so it is different. Yeah, include rental income or profit from foreign currency exchange. So let's say they do forex trading, so the income would be considered as other income. Companies present other income in separate section before income from operations. So they will separate it from the turnover that we record just now. Yeah, so to make sure that the user understand that this is not the main income from the activities. Okay, what about gain resulting from the sale of fixed asset? Can they be recorded as other income? Anybody? Gain resulting from the sale of fixed asset. Let's say the company sell off the building. The company sell off the car. Is it other income? It is not other income, yeah. It is recorded as extraordinary income because the sale of asset is not usually happen. Usually it will be happening when the asset is already obsolete, or the asset is already at scrap value. They don't use the asset anymore, so they want to sell. So that will be recorded as extraordinary income. Okay, so this is about expenditure. Okay, and expenses is a cost that occur as part of the company operating activity, and then it is usually using accrual method. Okay. All right. So and then okay, this is because I already explained a few times already, so I don't want to repeat. Yeah. Okay. Okay, an expense can occur in an accounting period that is different from the period when the company pays for the item. This is because of accrual basis. So maybe the expenditure occur this year, but the payment is done next year. So it can happen. Hence, the word expense has the meaning that is different from payment. So it does not mean that it is the amount paid by the company. Expense is something incurred. Okay, example, commission earned by a sales staff for selling goods in August is an expense for August, even though the commission is paid in September, right? So it is happening in August, but payment is done in September. So it has to be recorded in August as an expenditure in August. Example 2, the cost of electricity used in August is an expenditure in August, even though the bill is received in September and is paid in October, right? It has to be recorded in August. Okay, this is about finance income and cost. Yeah, if you remember the transaction that the financial report, financial statement of Nestle, finance income means all the interest or profit from deposit in financial institution. When all the companies definitely will have money in financial in account, and definitely will have money in the bank, right? When they have money in the bank, definitely, and then usually companies' money is in a big amount. So usually the amount of interest also is quite significant. So money from this particular financial institution will be the income from the money that they put in financial institution will be recorded separately in a finance income. This is the interest or profit. If the company put in the Islamic account, of course it will be profit. Yeah, if they put in conventional account, it will be interest. So this is where, when we do the Sharia screening, we can actually screen whether the income, the finance income, is significant or not. It will dictate whether the company is Sharia compliant or not. Okay. Finance cost is the interest profit that charged on the loan or financing with financial institution. Why these items are separated from other income and expenditure? Why? Why they are separated from other income and expenditure? Anybody? Because of this is important to show the riskiness of the company. If it is too much coming on cost, it will be very risky to the company. Okay. Okay, this is another item that you need to learn, EBIT. EBIT is earning before interest and tax. So what does it mean here is usually user would like to see the earning or the profit before the company pay interest and before the company pay tax. Yeah, usually they will, when they analyze the company, they will look at the profit of the company and then they will add back with the interest and they will add back with the tax. Why? Because what they want to see is the business operation, the profit from the operation. So that's why they take out the interest and they take out the tax. Another term is EBITDA. EBITDA is earning before interest, tax, depreciation and amortization. So this is actually profit before the company deduct the interest, the tax, depreciation and amortization. Okay. Okay, income tax, of course, the income that the company pay to the tax authority. What is implication if the company do not pay tax? Of course, they will be penalized or even the director will be imprisoned. Okay. Okay, so I already explained all this, yeah. Statement of financial position. All right, and then what are assets? So if you want to know more, then you can further read this one. Liabilities and also equity, yeah. And then again, I in this particular topic, I use the same company's transaction as Rin, and then I show you how the transaction happened, yeah. So this is actually all right. This is based on the same transaction that we discussed earlier, but now I'm showing you in terms of journal entry. Yeah, debit, cash, credit, equity. Actually, from the list that I showed you earlier, this can be understood as well, yeah. But this is showing you that the matching, you know, the matching recording that is done. Debit, cash, credit, equity. Debit, advance rental, 18,000, credit, cash, 18,000. So all the transaction that is recorded, then from here we put it in the account individually, like just like what we did earlier. So this is the trial balance. The trial balance is listing all the account with the debit balance and all the account with credit. Then we will see the balance equal at the debit side with the credit side. Okay, and then from here we prepare the statement of income. Again, the profit is 6,003, and then we do the statement of changes in equity, and then after that we prepare the statement of financial position. Yeah, so it has to be balanced here. Okay, so that is the end of presentation today. So I already covered topic 2, 3, 4 because it is related. So hopefully you are not confused with that. Yeah. Any question before we end the session? Anybody? Okay, if not, then I hope you can do the assignment. Yeah, I already give the assignment at Google Classroom. So if there is no question, let us end the session. It's sharp 12 p.m. Any question before I close the session? All right, I go one round. Munira, any question?
Madam, for the assignment,
Mhm.
do we make the table stating the credit and debit, or the table that just stating the asset, liability, equity?
Yeah, it would be supposedly question 4 and 5. What you have to do is you have to do this one only. Yeah, let me show again the what you have to do for question for the question 4 and 5. It is just this one. This is for the this is for question number 4. What you have to do from the list of item given, you have to do statement of income for 1 year for the company. What's the name of the company? Tulus Berhad. And then for question number 5, what you have to prepare is this one, statement of financial position. But of course the item is different. Yeah, make sure that you put correctly the item at the asset side, liability of, or equity side, right?
Okay.
So not that difficult actually, the calculation. Okay. Any more question?
No, Doctor.
Okay, what about Mahmud? Okay so far? Sundus?
It is okay, Doctor.
All right. Balio?
Yes, doctor, it's okay. It's too
Okay.
much information, but we'll go through the recording.
Yes, too much information. All right. I hope you can, if you don't understand, you can review the recording to understand further. And I hope you can
Okay,
do
if you,
the assignment. Yeah. So please
yeah,
submit
if you can
assignment.
upload the recording like
Yes.
earlier, it's
All
good.
right.
Because
I will record because we are doing this in the morning. So I will upload by 1 p.m. Okay.
okay, okay, no
I need
problem.
to make sure that it is converted to the video first, right? And then, okay, please submit assignment by 22nd April in Google Classroom, and inshallah, I will give you the mark in 1 week time, inshallah, so that you know already your 30% marks for this particular program, okay?
Okay, so this is for the this is before the final, right?
And
Or do
no,
we have to do another one?
Okay, no, this is one, yeah, you have another assignment from finance section. This is week 5, and this is week 5, yeah. 5 or 4, this is week 5, this is week 5 already. And you have another 2 weeks with me where I will cover the topic of cash flow statement and the topic of financial statement analysis. So, so for your exam, okay, not exam, yeah. This will be the first assignment which carry 30%. So it is covering the topic of 1 to 5, okay? And then topic 6 and 7 will be, will be tested in the final assignment, yeah, where it will carry 20% of the total, okay? But that will be final assignment. So meaning that I'm already giving you assignment 1. Dr. Romzi will take from week 8 to week 14, all the finance topic. Yeah, please bear with it. Please prepare yourself. Finance is also about calculation, a lot of formulas. Make sure that you have, whether you have the calculator or you can use Excel as well. Depends on the approach used by Dr. Romzi. Yeah, Dr. Romzi will take over the class from week 8 to week 14, teaching you the finance subject. And then, so Dr. Ramzi give another assignment. I gave 30% assignment. Dr. Ramzi will give another 30% assignment. One assignment also, 30%, meaning that second assignment, yeah. And then the third assignment or final one will be given by both of us. So we will give you final assignment. So 50% of it coming from accounting, 50% coming from finance. Okay, it's a combination of accounting and finance. And then the final assignment will carry 40%. So from me, I give you 30%. Dr. Ramzi will give another 30%. Another 40% coming from the final assignment. Meaning that for this course, you have 3 assignments. Okay, clear?
Yeah, it's clear, Doctor.
All right. So with that, any more question? If not, I end the session. Let us end the session with Tasbih Kifarah and Surah As. Okay, with that, I end the session today. See you next week. Okay, for next week, can we do the class in the afternoon? Because I have a meeting in the morning. Can we do the class in the afternoon?
Yeah, it's good for me.
Okay, yeah. All right. I will give you new link for afternoon class next week. Yes, so sorry. I understand. Afternoon is more challenging, more sleepy actually, but I hope you can bear with it. Prepare yourself. Maybe have enough sleep so that you won't be so sleepy in the afternoon, right? It's challenging, really. In fasting month, it's very challenging actually learning. Okay, so it's a test by Allah, and then of course you will be rewarded by Allah. Okay, see you next week in the afternoon. Yeah, thank you very much. Assalamualaikum.
Thank you, madam.
Welcome.